Hey everybody, this is CNEN, your crypto news entertainment network. This is Christopher. Let's get into today's topic. So, today we're going to be diving into a topic that could change the financial system forever. Trillions of dollars could soon be created out of thin air, just in a matter of seconds. And not by central banks or governments, but by crypto organizations that are becoming banks. This could lead to a level of inflation we have never seen before. Imagine a money printer that never stops, fueled by loans that create more loans over and over again. But before we dive into how crypto could create trillions, let's first understand the engine behind all of this: fractional reserve banking. All right, so let's break down how fractional reserve banking works in simple terms. All right, so what is fractional reserve banking? Well, fractional reserve banking is a system in which only a fraction of bank deposits are actually backed by actual real cash on hand and available for withdrawal. This is done to theoretically expand the economy by freeing capital for lending. If a traditional bank has person A deposit $100, but the bank only needs to keep 10%. That's $10 as a reserve. The other $90 can be lent out to person B. But here's the trick: person A still sees $100 in their account, while person B now has $90. Then person B deposits that 90% into another bank. That new bank keeps 10%, $9, and lends out $81 to someone else. This repeats again and again, so that the original $100 deposit can multiply into nearly $1,000 through repeated lending. According to the Federal Reserve Bank of Philadelphia, um, banks in the US create around $10.7 trillion per year through lending. That's about 57% of US GDP. Even more shocking, 92% of all deposits in the US come from this process, not cash deposits. And roughly 97% of all the money today exists as digital bank deposit, not physical cash. So most of our money isn't printed, it's created through lending. That alone should show you how powerful the system really is. All right, so moving on. Crypto companies entering the banking system. So now imagine if a company like Coinbase or Ripple or Circle could do this exact same thing. Well, they're almost going to be able to soon, and faster, cheaper, and globally. That's what's happening right now. These companies are applying for banking charters, official US banking licenses. For example, Circle has applied for a national trust bank charter with the US Office of the Comptroller of the Currency. Ooh, mouthful. That would allow them to manage USDC stablecoin reserves directly and operate under full federal oversight. Ripple has also reportedly filed for a US national bank charter tying into its new RLUSD stablecoin. Um, if these licenses are granted, they could hold deposits, make loans, and create money, just like any other bank. Even if their powers start off limited, the door to massive expansion would already be wide open. Um, so let's get into stable coins, digital dollars on steroids. Here's where things get really interesting. These companies already issue stablecoins, digital versions of the US dollar that move across the world instantly. If those same organizations gain banking powers, their stablecoins could be rehypothecated, meaning they can be reused as collateral in loans. That's money creation on top of money creation. And because crypto operates 24/7, this system never sleeps. Traditional banks settle in days, crypto settles in seconds. Combine that with global reach and automated lending systems, and you get a money multiplying machine. Many crypto platforms already offer eye-popping yields that make savings accounts look like pocket change. But the real twist, the potential inflation bomb, comes from DeFi, or decentralized finance. So let's talk about DeFi and DeFi lending loops and how they take this whole banking system to another level. So someone deposits USDC um, into a lending pool. Others borrow from that pool. The depositor earns a small yield, usually like a percent or two or something like that. But then people realize they can borrow against their own collateral, redeposit, and borrow again. That's a DeFi yield loop. Let's make it simple. FYI, the infographic I'm about to share is different from the scenario I'm about to provide as an example. So here we go. Sorry about that. All right, so here's the example. To get you guys to understand if you don't already. So you deposit $1,000. So you can borrow $800 because there's a 80% withdrawal limit, basically. So you of the collateral you deposited in, you can only take out, say, 80% of it. But then you redeposit it and you borrow another 80%, $640. You redeposit it, borrow 512, and so on. After a few loops, you've deposited around $4,500 in total and borrowed about $3,500. So let's just say, for an example, you're earning 5% on the $4,500 that you have deposited. 5% interest, it's not bad. But then you're paying 3% interest on the 3,500. That's a net of $120 in profit per year, which is a 12% yield compared to the original 5%. So that is the power of DeFi looping. Compounding yield through recursive borrowing. Remember, it is extremely risky. If prices fall or rates change, you can get liquidated instantly. We saw that today or yesterday as the entire crypto market dropped about 20 to 25%. So, anyways, moving on. Now let's combine that with banking power. Crypto banks are using DeFi because, of course, they are. When you put it together, crypto banks and DeFi and looping, you get near infinite money creation. Imagine crypto banks using DeFi. When you put it together, crypto banks plus DeFi plus looping, you get near infinite money creation. So here's the math. If a crypto bank holds $10 billion in stablecoins and follows the 10% rule, they can support $90 billion in loans. If users loop those funds 3 or 4 times in DeFi, the exposure could exceed 250 to 300 billion, all built from the same $10 billion base. That is money creation on steroids. Steroids. Oh my goodness, this is what's going to happen. I tell you. Um, Near instant, global, automated, and potentially unlimited. The result? A dollar supply that could explode overnight. That means rampant inflation, higher prices, and massive financial instability if it's left unchecked. If is a big if, but with how everything is today, it's really hard to say what would happen. But to be fair, there are some safeguards. Regulators could require higher reserves, capital requirements, or limit rehypothecation of collateral. The FDIC and OCC might also set special rules for crypto banks and stablecoin issuers. So it's not guaranteed to spiral, but the potential is enormous. Even with regulation, the combination of crypto banking and DeFi could unleash the most powerful money creation engine in human history. The US could face inflationary pressure on a scale we have never experienced before. So the question is, are we ready for what comes next? We're standing at a financial crossroads. Crypto banking and DeFi could redefine what money even means. Understanding this system is crucial. Before we regulate it, criticize it, or profit from it, let me know your thoughts. This is CNEN, your Crypto News Entertainment Network. I'm Christopher, and if you found this breakdown valuable, like, comment, and subscribe for more deep dives just like this. See you guys next time.